Youngsters like us frequently mix up the meaning of 401k and IRA. You might wonder, how much is the maximum annual contribution limit for individuals under the age of 50 in a 401k plan? Are all employers required by law to provide a matching contribution to their employees' 401k plans? We know you've got a lot of questions to ask. Well then, Stealthies, they're entirely different from each other, but might serve the same purpose. Let's break down the difference and how we can use them to our advantage as young adults. Nevertheless, prior to delving into the specifics, we kindly remind you to click the subscribe button for the purpose of staying informed about Stealth Society's financial videos. By doing so, you will have the opportunity to acquire valuable insights and uncover several strategies to enhance your wealth. There are two primary choices for saving money for retirement: 401k plans and individual retirement accounts, IRAs. When employers want to provide their employees with a tax-advantaged method for saving for retirement, they may offer participation in a defined contribution plan like a 401k. In a 401k, employees usually contribute a percentage of their salary, and the employer may match those contributions up to a certain limit. If the company has 100 or fewer employees, employers might also offer a simplified employee pension, SEP IRA, or a savings incentive match plan for employees' simple IRA. Alternatively, individuals can choose to save on their own and open an IRA. It's possible to have both a 401k and an IRA. However, IRAs do not include matching contributions from employers. Different types of IRAs have specific income and contribution limits, as well as their own tax advantages. Both traditional IRAs and 401ks grow tax-free, meaning that interest and earnings are not taxed over the years. However, when distributions or withdrawals are made in retirement, they are usually subject to taxation at the individual's then income tax rate. Nevertheless, there are certain IRAs that allow tax-free withdrawals in retirement. Most IRAs and 401ks prohibit withdrawals before the account owner reaches the age of 59 and a half, or else they incur a tax penalty imposed by the Internal Revenue Service, IRS. Again, depending on the specific retirement account and an individual's financial circumstances, there may be exceptions to the early withdrawal penalty. 401ks. A 401k is an employer-provided retirement savings account that offers tax benefits. Employees contribute money to their 401k through elective salary deferrals, where a portion of their salary is withheld and directed to the account. These contributions are then invested in various options, typically a selection of mutual funds chosen by the plan sponsor. The available funds are designed to match different risk preferences, allowing employees to choose investments that align with their comfort level regarding risk. Any income generated from these investments grows and compounds without being subject to taxes. Additionally, many employers now offer Roth 401k options. Unlike traditional 401k accounts, contributions to Roth 401ks are made with after-tax money and are not tax deductible. However, qualified withdrawals from Roth 401k accounts are tax-free. Employee contributions. Contributions made to 401k accounts are considered pre-tax, which means that the total amount of contributions reduces your taxable income for the corresponding year by the contribution amount. To illustrate, let's say an employee earns a salary of $50,000 and contributes $10,000 to their 401k. In this case, the taxable income for that year would be $40,000, assuming all other factors remain constant. For the year 2022, participants are allowed to contribute up to $20,500 annually to a traditional or Roth 401k. An individual age 50 and older can make an additional catch-up contribution of $6,500. However, the contribution limit has increased for 2023, allowing individuals to contribute up to $22,500 with an additional catch-up contribution of $7,500 for those age 50 and older. Matching contributions. Employers commonly provide a matching contribution to their employees' 401k accounts, typically up to a specified limit or percentage. The matching percentage may be based on the employee's annual contributions. For instance, an employer might match 50% of an employee's contribution up to 6% of their salary. If the employee contributes 6% of their salary, the employer will contribute a matching amount of 3%. In certain cases, employers may establish a matching policy that is effective up to the IRS limitations without exceeding them. For example, a company may state that it will match 50% of all 401k contributions up to the contribution limits. In this scenario, the company may match up to $11,250 in 2023, 50% of $22,500. If an employee does not contribute the full 6%, they may not qualify for a match and could receive either a reduced portion or no matching contribution from the employer. To be eligible for the employer match, the employee may be required to contribute a minimum amount or percentage of their salary. It is crucial to review the documents of the 401k retirement plan to determine if there is an employer match, and if so, what the maximum match amount and minimum employee contribution are to qualify for the matching contribution. The IRS has set limits on the total contributions made by both the employee and employer to a 401k for 2023. The total contributions cannot exceed $66,000 or $73,500 with catch-up contributions. Alternatively, the total contribution to a 401k cannot surpass 100% of the participant's compensation. Distributions from the retirement account are subject to taxation based on the individual's income tax rate. However, withdrawals made at the age of 59.5 or older do not incur any penalties. Individual retirement accounts, IRAs. There exist multiple varieties of IRAs, which are retirement savings accounts that provide tax deferral and are established by individuals. IRAs can be held by banks, brokerages, and investment firms. We understand that you may have concerns about investing your money wisely and effectively and managing it over the long term at Stealth Wealth Society. To address these worries, we have developed user-friendly solutions. To gain access to our tailored financial courses that cater to your specific needs, simply click the link provided in the description below for exclusive front row seats. An IRA can be as simple as a savings account or a certificate of deposit (CD) at a local bank. IRAs held by brokerage and investment firms offer account owners a broader range of investment choices compared to 401k plans. These options include stocks, bonds, CDs, and even real estate. However, it's important to note that certain assets, such as art, are not permitted within an IRA as per IRS regulations. IRA Contribution Limits. The annual contribution limits for both traditional and Roth IRAs were $6,000 in 2022, and individuals aged 50 and older were allowed an additional catch-up contribution of $1,000. However, for 2023, these contribution limits have increased, allowing individuals to contribute up to $6,500 with an additional catch-up contribution of $1,000 for those aged 50 and older. Similar to 401k plans, contributions made to traditional IRAs are typically tax-deductible. The earnings and returns on investments within the IRA grow tax-free, and taxes are owed on withdrawals during retirement. On the other hand, contributions to a Roth IRA are made using after-tax dollars, meaning there's no tax deduction in the year of contribution. However, qualified distributions from Roth IRA are tax-free during retirement. Similar to 401k plans, individuals with IRAs can commence making withdrawals once they reach the age of 59.5. If withdrawals are made prior to that age, a 10% tax penalty is imposed, unless the individual qualifies for a hardship withdrawal. It's worth noting that unlike 401k plans, the IRS does not permit borrowing against the balance of an IRA account. Is it better to have a 401k or an IRA? Determining whether a 401k or an IRA is more suitable for an individual depends on their specific circumstances. While a 401k permits higher annual contributions on a pre-tax basis compared to an IRA typically offers a wider range of investment options, granting greater control and flexibility over the account. It's worth noting that an individual has the option to have both types of accounts concurrently. Both a 401k and a traditional IRA serve as vehicles for retirement savings, but they differ in their nature. A 401k is an employer-sponsored plan that operates under specific regulations and guidelines. Conversely, a traditional IRA is an account established by an individual without any involvement from an employer. Is a 401k considered an IRA for tax purposes? Retirement accounts vary in their tax treatment, with different tax benefits applying to IRAs and 401ks. Roth IRAs do not provide a tax deduction for contributions, but withdrawals during retirement are tax-free. On the other hand, traditional IRAs offer a tax deduction for contributions, while 401ks allow for the deposit of pre-tax income, thereby reducing taxable income in the year of contribution. Distributions from both 401ks and IRAs during retirement are considered taxable income. But you might ask, can you lose money in an IRA? Indeed, when an IRA is held by a brokerage or investment firm, the funds are typically invested in securities such as mutual funds or stocks, which can experience fluctuations in value. It's important to recognize that an IRA is subject to the same level of potential value decline as any other investment account. The owner of an IRA encounters comparable market risks to those faced by an individual holding a 401k account. The Internal Revenue Service, IRS, permits the transfer or rollover of funds from a 401k to an IRA, but it's crucial to adhere to the specific process and guidelines provided by the IRS to ensure that the transfer does not count as a distribution, which may result in a penalty. The simplest and most reliable approach to ensure a penalty-free rollover is to opt for a direct rollover. The bottom line: IRAs and 401k plans are valuable investment tools, each with their own unique advantages. While a 401k may offer limited investment choices due to its employer-sponsored nature, it compensates by providing significantly higher contribution limits compared to traditional or Roth IRAs. Ideally, combining both types of accounts allows for the creation of a well-rounded retirement portfolio, enabling individuals to enjoy their golden years with peace of mind. Do you want to gain access to a wealth of advantages when it comes to your finances? Stealth Wealth Society has designed an interactive course that provides guidance on setting and achieving financial goals, creating a sustainable budget, and understanding the complexities of the modern financial landscape, and more. This course offers incredible value for the lifelong benefits it provides, making it a wise investment in your financial well-being. Don't miss out on the opportunity to secure a solid financial foundation and unlock a brighter future. The link is in the description below. With that being said, we trust that you'll find this video to be valuable. To stay up to date with our newest videos and discover more financial tips and tricks, remember to subscribe to our channel, Stealth Wealth Society. If you've had positive experiences with planning your 401k and IRA, we encourage you to share them with us in the comment section below. Till next time.